We have a lot to discuss. Earlier this year, Peter Rodriguez, Dean of the Jones Graduate School of Business and the Verani Undergraduate School of Business at Rice University, was appointed to the Federal Reserve Bank of Dallas Houston Branch Board of Directors. As a member of the board, Rodriguez provides input on our region's economy to the Dallas Fed, which works with other regional Federal Reserve banks to guide our nation's economic policies. To tell us more about his new role with the Houston Bank of the Dallas Fed and give us his thoughts on the dramatic market swings we've seen in the last few weeks, we welcome Peter Rodriguez himself. Peter, good morning and welcome to Hello Houston.
Good morning. It's my pleasure to be here. Thanks so much for having me.
Glad you're here. We have a lot of questions.
That's right.
I'll do my best. Thanks. Keep them coming.
Just today has been a very interesting morning so far. We are seeing dramatic swings in the market. Right off the bat, what do you think is going on?
Well, this is all about uncertainty. And if there's one thing that's just toxic to financial markets and really gums up any business decision, it's I don't know what's going to happen next. Therefore, I hold my cards. I don't play. And everyone in the market is trying to figure out where this trade war is going to go and how long it's going to last. And that's what you saw today.
There was a rumor that Trump was going to pause the tariffs, and that turned out to be a rumor.
It seems like it turned out to be a rumor, but it also seems like the market may have half believed that there was some room because I think what the market is trying to figure out is how much of this is a negotiation, how much of it is not, how much of it is just we're releveling the playing field and get used to the new world order. If that's the case, markets are going to adjust and say that's a big change and we're going to prep for a big change and prices will go down. If they think, and what seems to be the case with prior actions by the Trump administration, everything is open to some negotiation, then there was this question, and it's not clear where that's going. I think you'll start to see Fortune 100 executives, people like Jamie Dimon, come out and say, hey, wait a minute, let's not throw the baby out with the bathwater. Maybe these Vietnam tariffs are too high, maybe the same for South Korea or EU. And so the market just has a lot of uncertainty to digest, and that's why the markets are down.
When you talk about uncertainty, my concern in all of this is whether or not Trump decides to roll back things or put them forward, global markets now can't trust what is being said from the White House. There's no way to build business plans off of something that is so erratic. Is that a true fear, and does that truly impact the way the global economy reacts?
It does. And since you started a trade war, what you have is all these reactions and then reactions to the reactions, right? So the Chinese counter, and then we counter their counter. And then if you can't hold on to that, then you just have to wait. You can't afford to decide. Imagine you're Nike. Do you pull your plants back to the United States or some friendlier country today? Or do you wait a month, a quarter, long enough to say, now I know, now I feel good, I'll make some big decisions?
Well, and I'm hearing it would take 10 years to build a new plant, and then it's going to be full of robots.
I think that's the real concern, too. What are you going to do? How long does it take? If you decided today, I'm going to start a new plant, well, you got to get your architects. You got to get the land, property, and equipment. Even if you move all of yours, do all your suppliers come or not? Do you have the storage?
And do you really employ people?
And do you really employ people? And I think that's the challenge for global manufacturing is that around the world, those are good jobs. We understand why everybody wants them. I want more. Everybody does. But manufacturing jobs just continue to go down because we have more automation, and automation is the other competitor in the market that we're trying to deal with.
We want to remind everyone that we welcome you to the conversation. Give us a call, 713-440-8870. We are speaking with American economist Peter Rodriguez.
So I'm hearing, as I'm sure everyone is, that, oh, well, we were being ripped off. Everybody else had a sweet deal. We were being taken advantage of. And my reaction to that is, well, okay, they had a sweet deal. We had sort of gotten used to it. We had a great market going at 45,000. We had interest rates at 6%, which is, from when I was growing up, pretty good.
Pretty good.
And unemployment at 2%. So even if they had a sweet deal, we were enjoying a sweet deal as well, right?
Well, the economy looks really strong by a lot of measures. So if you asked for a point in time today, you'd say unemployment around 4%, which is the lowest you can really get it without stoking inflation. I think that you saw the market doing really, really well. We come across, two back-to-back, 20% plus years in the markets. That's fantastic for your 401k and everything else. It's difficult to make these kind of changes. And the U.S. is the world's leading economy. We trade a lot. Even if we don't export as many manufactured goods as we want, we export about $3 trillion a year. We're really big. And we also have a net surplus in services. So what we really specialize in are financial services, insurance, consulting services, education, everything else. That's what our real strength is. So there was a good balance in the world economy from the standpoint of strength.
Right. That's what I'm saying. We were balanced, even though we may have been getting ripped off or being taken advantage of. We're the strongest economy out there. Of course, we're going to get taken. It's like when you have the rich parents and everybody else wants a handout.
And I do think that there's reason to want more jobs of the kind the Trump administration wants. And I do think there's a good reason to want certainly lower budget deficits and the like. But this approach seems to be chaotic, at least at the moment, and I think that's what has everybody spooked.
But Peter, question for you. Frank mentioned ripped off. Were we really getting ripped off? Is
it's
that
hard
the
to
correct term?
Good point.
There's all sorts of tactics and advantages out there that countries use, and I have no doubt that there were subsidies happening that wouldn't be necessarily a level playing field. But that's really hard to get. Everybody has a different set of rules, and in the world trading market, we sort of learn to deal with them the best way we can. What we did have better control over was trade in North America, where we had sort of integrated the three economies into one big economy, and that makes good sense. And a good relationship with the EU, where they have high wages and high labor costs and other things that make us feel like the playing field is more level. The real issue seemed to be with more or less China, and now we've got the whole world mixed up.
Well, and doesn't it seem a little hypocritical to say, well, we were being taken advantage of when billionaires are taking advantage of our tax system every year?
Well, there is this question about what does it really do for manufacturing jobs in the U.S. and what is being taken advantage of and what is not. You have to unwind so many things. And I would start with not necessarily the billionaire piece, but all the sort of subsidies we have for industries that we favor and want to protect are also thrown into the mix like there are everywhere else. We like to have steel, which is important for strategic reasons and national defense reasons. But there are a lot of subsidies for agriculture and other things in the United States because we like those industries and
I came from
keep
farmers.
them strong. And, there's good reason to have those. But once you start adding in everybody's policy for protecting their favorite industries, yes, you could see the playing field seeming unlevel, but it's really hard to measure, and there's no good way to measure that.
Should we be focusing on manufacturing jobs as this nation today when it comes to the cost of things, and that we know in other countries, at least traditionally, they can produce these things much less expensively? We could be using our workforce to move forward into the worlds of technology and AI and all of what's coming next. Are we putting out a great plan for 1950 and not a great plan for today?
Well, that's a great question, and it's really hard to know where the puck is moving. But we know we want to move where the puck is going. And I would say that, manufacturing, there's nothing particularly special about that job itself. What we want are high-quality, high-paying jobs. That typically takes a lot of skill. That could be in services or other things that people do. And there are clearly some jobs that, if you brought them back to the United States, wouldn't really lead to the type of job quality we want. So a lot of things we'll talk about, like some of the very low-end manufacturing that you see happening in Vietnam and in China, I don't think that's actually going to produce a wage in the United States that's very useful. And you can think about Apple and the iPhone. You can assemble them here, but it's much better to design them here and get paid for the higher-end production, that the higher-end technological production it needs to go inside the phone than to just assemble the phone.
And speaking of manufacturing, President Trump says that, we, the United States, we're going to hurt for the next 2 years. But doesn't repatriation of manufacturing take decades, take years? So
it does.
Where is the 2-year timeline that he keeps mentioning come from?
I don't know where that is. Maybe he's thinking about the market getting optimistic after the change take place, but there's no way that you could repatriate that much. And then you have to think about another issue, which is if you have full employment, which we more or less do today, where do the new workers come from? And it means you have to churn something in the market. Something has to give so that something else can be added. And that's a hard question to answer. That's what the market sort of sorts out over time. But that in itself is a source of uncertainty. And so you're right. These are more 5 to 10 year changes than they are 2-year changes. Well,
it's almost like and I don't want to play the blame game, but small town America was with all the little drugstores and the toy stores on Main Street, that was replaced by Walmarts. Right? Mm-hmm. So Walmart came in and built their big buildings. Well, then that was kind of replaced by Amazon because you could just call or get online and all of a sudden it's here. And so to your point that, we've got to be more forward thinking than trying to go back into the days of manufacturing everything here. Do you think NAFTA can be saved if we clean this up fast enough?
Sure, and I think we have two ready partners. The good thing about the Canadian and Mexican markets are they're close, so there's a natural advantage with shipping costs. We've been working at this for 30 years, so all the supply chains are integrated here. All the infrastructure has been put in place to make us one big manufacturing and trade unit so that we can compete as North America with China, with the EU, with the rest of the world. That can be saved, and I think that's a much more sound way to think about going forward with good jobs and the right types of jobs. The real issue is how do you get the young people of today skilled in a way that's going to enable them to have good jobs? And there are a lot of ways to do that. Manufacturing alone won't be enough, and it is a difficult market to chase.
Just to remind everyone here, we're talking with Peter Rodriguez, who's the Jones Graduate School of Business, from the Jones Graduate School of Business, I should say, and also is appointed to Federal Reserve Bank of Dallas Houston Branch Board of Directors. We're taking your calls about the economy and what's happening out there. 713-440-8870, 713-440-8870. You've got questions about the economy. I can't think of a better person to answer them for you, so give us a call.
That's right. No, I have, moving a little bit more towards right here at home. President Trump, has been pushing for Federal Reserve Chair Jerome Powell to lower interest rates. Is this the right time to do so? And is lowering interest rates as easy as President Trump is making it seem?
The thing you have to do on interest rates is to think about the whole state of the economy, and there are two big factors the Fed has to consider by its mandate. One of them is inflation. So you want stable prices at around 2% by the measures we use, and you want full employment. Today, we more or less have what we would call high employment levels at around 4%, and we're still not back down to that 2% level of inflation that had been our baseline for really 25 years and was really upset by COVID. It's taken us 2.5 years plus to get down to where we are. So you don't have evidence that you can lower rates today. Jobs are still plentiful, so that's the good news. So there's just no case to lower rates yet. We'll have to wait to see evidence of things we don't want, would be one, like a softening labor market or a loss of jobs. Then you might have a case to lower rates. But you really just don't have the prices where you need them. If inflation today were 1.8% per year or 1.9%, sure, you could think about lowering rates at the early signs of a weakening job market. But you can't do that. Inflation's still too high.
Do you have any fear of deflation, the opposite? And if so, what would that mean?
Well, you can get that. And the Fed also worries about deflation. In fact, everything we did after the global financial crisis in 2008 and 2009 was to try to fight that, because you saw prices even temporarily go negative. And that can be difficult because when prices are falling, nobody does anything. You just wait for them to fall further. And that leads to this downward spiral of your economy. I don't think that's a risk until we would get pretty severe market correction or a downturn that's really worrisome. So I hope we don't get there. But at the moment, we're not. I would think that the Fed, most people were predicting a couple of rate cuts this year. We were already feeling like we'd gotten most of the work done on getting inflation back down. Markets bets today look more like maybe one cut this year, maybe none. It depends. And tariffs typically raise prices, not lower them. And so this sort of a tariff war creates a problem.
A question about tariffs, though. The president's doing them with executive actions. Aren't they something Congress is supposed to impose?
Yes, they can. If the president claims that these are, exigent circumstances because of extraordinary economic risks, he can act. And Congress can check that. They've not chosen to date. I think that if we don't see a return to sort of clear skies ahead, or if you see some pain being exacted on the economy, my guess is some congresspeople will react. But to date, they haven't, and they've given President Trump, I think, what you'd call a honeymoon period to do almost anything with respect to tariffs. And this is a big move. I think they were on board when he was elected, and they are on board today, as far as I can tell.
And even honeymoons get boring.
Yeah,
I'm
maybe.
tired of
or
the
at least
if President Trump called you, Peter, and said, "Okay, what do you think I should do?" What would you tell him?
Well, I think the first one is that high tariffs aren't really good for anyone in the global trading order. You can have some tariffs, but the way we've gone about it is really chaotic. And so, first and foremost, I would say you've got to leave some good outs for the allies. It can't be one versus the world. And I think this tariff position we have is a little bit too one versus the world.
And what's with the tariffs on islands that are full of penguins?
Well, I think that was just kind of the haste that they took in putting together this formula. The good news is we don't trade much with those islands, so they don't matter much anyway. But as far as they're moving quickly,
there is that.
It's just so funny.
But I would say that the issue won't be the EU. We didn't include services in our trade deficit with them, and we should have included services. They buy a lot of services from us. Those are good jobs. That counts.
Define services.
So that would be not a trade in a physical good, but let's say you buy software services from someone producing in the U.S., or let's say your bank is here in downtown Houston. Then that means that you're getting services, and we're basically supporting jobs in the U.S. because you're importing those things. Well, those are high-quality jobs, and we should have included that in the measure of the tariff. So I think we've over-tariffed some allies, and I would say I would rather not do that. I think you can focus on the bigger, thornier issues with countries like China.
So that would be the quick fix.
Yeah.
What about the long term? How do we get the markets back?
Well, the markets need to be convinced that this is going to work and that they can be profitable. And what has them worried right now is they can't move their plants back to the U.S. and have the same level of profits. And so if they can't have the same level of profits, then it's right that their stock should be trading at a lower level and a lower multiple. And so until they feel like they can be profitable, there's no fix.
Let me take you back and kind of, you're in the White House. What is the philosophy behind what we're seeing happen here? What were they hoping to accomplish that we may not understand as we watch
Please tell us there's
as we
somebody
watch
behind the curtain.
sausage being made. We're not seeing the sausage.
I don't have any greater insight than you do, but I would say a lot of the philosophy has to be this point of view that the only reason we have trade deficits, especially in manufactured goods, is because others are cheating. In other words, that we don't lose unless there's cheating somewhere else. And I think that that's probably overstated. It's true that there are countries that trade with us and they have low labor costs, but that's our advantage to our consumers. And you can't have one without the other. You can't have lower consumer prices because production is cheaper and bring it back to the United States where production costs are higher at the same time.
They talk about trade inequities. And if I understand, that seems to be something that doesn't really make sense. If a small country buys less from us because they can't either afford our products or there's not as many of them, and we buy more from them because they produce things we want, what's the point in trying to make that equal? That's the way the system works, correct?
That's correct. My other piece of advice to the White House would be there's no sense in trying to have balanced trade with each and every country. You might want to have more balanced trade overall, but if we buy bananas from Costa Rica because that's where they grow bananas really well and really cheaply, then we ought to do that. There's no way they're going to be able to buy as much from us. We're a much larger, much richer country.
Right.
So that bilateral balance is not a productive or economically sound balance to look for. And that example anyway, doesn't reflect any cheating of any kind. What you really want to look for is to say, let's make sure we aren't hollowing out industries too quickly or losing too many jobs. And what we can do about them, we can take a lot of measures to. Trade is only one, and it wouldn't be my instrument anyway, but that's only one measure.
Switching gears totally. Oh, sorry, I cut off Celeste. Let me ask this, then I'll toss it over to you. People are worried about their retirements.
Sure.
People are worried about where their investments are. Should people just sit and wait, or should we be being proactive?
That's a hard question to answer. It's really idiosyncratic, of course. When you see the market go down as much as it has in the last week and a day like today, it's got to make you nervous. If you really depend on that cash coming out, you're going to want to be in safer investments, and that's a rational thing to do. I'd be a little bit gentle about that because there is enough uncertainty that you just don't know, and so moving in haste or moving into something that has no high likelihood of appreciating is a little bit costly. But I think this is exactly the type of market circumstance that leads people to be a little more cautious. And if you're in a retirement state or on a fixed income, or if you are really worried and really need that dollar inflow per month to be steady, hopefully you were already in something that wasn't too risky. But if not, this is going to move you at the margin into that. And that's rational. It just, it shouldn't be too large.
So, okay, Peter, I really want to hear about your new role with the Federal Reserve Bank of Dallas, Houston branch, board of directors, because we all drive down Allen Parkway and we see the big red brick building. And I'm always so curious. educate me. What
where the
exactly
magic happens.
in there?
Yeah.
What do we need to know
Is there any
about the
money
Federal
in there?
Reserve Houston branch?
Yeah, there's a lot of money in there, actually. All the cash that you see at ATMs or in banks in this southern part of the state really flows through there. And the reason why there's such high security and why it's well above the bayou is to protect that. They literally have, just like you see in the Die Hard movies or whatever, just reams and reams of cash in there.
Do we really want to be telling people this?
Yes.
It's
Tell
no
me more,
secret
Peter.
to the Bruce Willises and others of the world. But that's part of what they do is that type of banking function. But mostly what they want to do is take a pulse on the economy so they can feed that information back into the Fed. And the role of the board is to really communicate from the energy sector, the healthcare sector, NASA, education sector, everywhere in this city and region. How's it going? What are you experiencing? Where are businesses? And therefore, how do we adapt our policy in the smartest way to fulfill our mandate? And that's really what's taking place. And they're a convener of great conversations about all of that.
So how is it going? What's your prediction in our region right now? How are we doing with all of this going on around us?
It's been great so far. This is a real significant moment because some things are happening that would normally worry us. So, for example, you saw WTI is down and there's downward pressure on energy prices. We're a huge trader here in Houston and in this region. And in fact, if you look in the United States, really the largest export we have is crude oil and natural gas and energy-derived products, whether they're plastics or other chemicals that are used in fertilizers. So we're a huge, huge part of global trade here. And when you see that market shrink a little bit, well, we know what that means. It sort of means that there's going to be less money flowing in and around the economy if that persists. But it's a volatile market. It could turn way back up tomorrow. And that's one of the challenges of the energy industry. But we're okay, but that's a bit of a worry. Then you also have the Port of Houston, which is an extraordinarily important port, second, I think, largest in terms of trade activity in the United States in a year. It's really hard. I don't think anybody's going to turn away crude or natural gas. That's sort of industrial oxygen, and that doesn't happen quickly. But we do see that as being a risk, and we see the other services built around that at some risk. So we're at a little bit of a delicate point, but I think we're coming from a strong place, and we're certainly not weak at all. We've been really strong. A lot of in-migration to the city and the region because we produce a lot of jobs. Housing costs have been more manageable here than in other major markets.
So what's the takeaway? Folks listening today, give me a 15-second end to us.
We're coming from a strong place, and we've got great, strong roots. The good news from today would be that this policy seems to be absolutely panicking a lot of markets. It's understandable, but the good news about it, policy, is that it's just a policy. It's not a structural foundation. It can be reversed. And
I hope the president calls you.
Well, we can leave him my number. I don't think he'll be calling me. But I think, the good news is that there's room to change this. This isn't like saying we've lost something that can't be gotten back. It can be gotten back, or it can be moved back through a negotiated process anytime, and that's positive news for us.
Peter, thank you very much.
My
Peter
pleasure.
Rodriguez is the Dean of the Graduate and Undergraduate Business School at Rice University, and he's on the board of directors of the Federal Reserve Bank of Dallas Houston branch.